So I know many investors tend to seek solace or some sort of comfort, especially in the endeavor of stock picking, because of this idea of social proofing. Hey, if Warren Buffett bought this stock, it couldn't be that bad, right? It's Warren Buffett, god of investing after all. So the stock probably wouldn't do too badly because based on historical performance of Buffett himself, or insert any super investor's name here, they are well respected in the industry for a reason and they've outperformed the market over a long period of time. However, the way of thinking is probably bad enough. So the idea of seeking confirmation from our fellow human species is innate of the human condition. But we need to be able to learn and discern from the mistakes that we committed. And if your thesis is because, Charlie Munger bought it, that's why I bought it too, then you might as well buy into Daily Journal or even Berkshire Hathaway for that matter, so that you have them help you manage your money instead. You know what else you need to manage? Managing the like button by gently tapping on it so that we can exploit the concept of social proofing and convincing other people and other viewers to watch this video as well. Now, even though I've started this video convincing you that it's a bad thing to seek some sort of confirmation biases, especially from other high-profile investors, we all know that we are extremely curious creatures to begin with. So okay, maybe we're just busybodies and not really curious. But I think I just wanted to correct any potential problematic mindset before looking at how people are both trading in and also out of Alibaba. So of course, at the top of the list, we have Grandpa Munger, essentially making it as the face of Alibaba, at least in the value investing space. So he recently trimmed 50% of his position in the latest 13F filing via the investment portfolio that he manages, which is Daily Journal Corporation. So I'm not going to belabor the point, if not people will keep commenting that I'm exploiting Munger to create more content. But it's true, is it not? But the current consensus is that there is a very high probability that he tax loss harvested on his initial Baba position. So you can check out this video as I've consolidated all the different theories and also triangulated them for a clearer picture for you as a retail investor. So since we are already on the topic of selling Alibaba, I'll write on to two more higher profile funds that cut their exposure in Alibaba in Q1 of 2022 as well. So first, we have Tiger Global Management, currently managed by Chase Coleman with a 26.6 billion portfolio value, who is also a billionaire himself by the way. So he cut the entire stake of Alibaba, totaling around 4.2 million shares just last quarter. And based on the activities, he actually held through the entire duration of the crackdown because he initiated this BABA position even before 2020, before this so-called crackdown on tech. So this eradication is not a vote of no confidence to China by the way, it's probably a vote of no confidence on the business itself because his top position in this specific portfolio now is actually JD.com, surprise surprise, sitting at 10.59% of the portfolio, despite also reducing the position size of JD even though it's a small extent. Now, particularly for Tiger Global, it's a rather diversified portfolio with more than 69 stocks. And his quarterly activities are beyond imagination. I'm not too sure how they even keep track of it, but take it for what it's worth. Next, Greg Alexander has also recently trimmed his entire Alibaba position of around 2.1 million shares, while at the same time keeping his JD position at around 7.4%. It seems like we can kind of observe a common theme here, where these portfolio managers just seem to favor JD over Alibaba and are not really concerned about your daily coffee shop talk about, the regulatory crackdown, Chairman C is out to kill, ADR delisting, and so on and so forth. So the entire idea of the government going to impair capitalism and shareholders' value don't seem to hold any water. So it's a great food for thought, especially for existing backholders who only have Alibaba position. I'm also sure most of you actually monitor JD and Pinduoduo closely because it paints a much more holistic picture of the e-commerce industry by and large in China. So it might be a good time to relook into JD's business model and economic mode compared to Alibaba, given that there is this shift in sentiments and this favoring of JD over Alibaba. So of course, if you're interested, I can make a separate video outlining the thoughts between the two. Leave in the comment section if you're interested. So you know what else I need to outline my thoughts on? Of course, it's on this 100% ROI deal. From now until 31st of May 2022, if you actually sign up for the Standard Chartered Smart Card, you'll receive an AirPods Pro for free and you can get to enjoy up to 6% cashback in the forms of reward points with no minimum spending required. Furthermore, there is no annual fees attached to it, and you get 3 months of free Disney Plus subscription. Anyway, you can head down to the link below to sign up for your Standard Chartered Smart Card today, and you just have to spend minimally $350 within the first 30 days of your card approval. Don't let this 100% ROI deal get away, and it expires on the 31st of May 2022. Now, back to the topic. If you were to look at the flip side, because in the stock market, there is always someone making that opposite side of the trade when you think you're the smart one by buying or selling, and somebody is taking the opposite position. So the next most high-profile investor that is also known to be the big bull of China and Alibaba, right after Munger, definitely goes to Ray Dalio and Bridgewater Associates. So he even wrote an entire book on the potential of a changing world order. Highly recommend both the video and the book, by the way, even though I'm not really done with the book yet because it's not your typical walk in the park kind of book. It really takes a lot of time and effort to actually consume his content. So under Bridgewater, Ray Dalio actually added another 3.2 million shares in Alibaba, making it the 6th largest position of the 24 billion portfolio. That said, he has been a net buyer of stocks in Q1 of 2022 and has since then added many strong American brands into the portfolio as well. So it's not really a sector or a specific Alibaba bet, it's a stock market bet. So despite being a huge China bull himself, he doesn't just long China and short America. I'm oftentimes quite dumbfounded as well, where people make this kind of binary choice of investing. Where you are long China, you definitely must be anti-America as well. It's crazy. Why can't we hope that both countries prosper and both their companies will compound in the long run? What's wrong with that kind of ideology? It probably is quite detrimental if we constantly think from a zero-sum perspective. In order for me to win, somebody must lose. Extremely toxic. Secondly, another relatively bigger fund out there, First Eagle's Investments, added 38% onto their Baba exposure. And likewise, they don't really hold a very concentrated portfolio because there are more than 69 stocks in here as well. And Alibaba sits at around rank 24, constituting around 1.53% of their portfolio. However, particularly for First Eagle, they do not concurrently hold any other Chinese e-commerce ADRs, like JD or even Pinduoduo. So the conclusion is, wait for it, there is no conclusion. Nobody told you that investing was easy. Of course, other than those annoying YouTube ads. Anyhow, it's never possible to draw conclusions from simple actions of buy and sell by all these so-called top hedge fund managers. Because if not, all of us can and will be managing huge sums of money. Another point to note is that on such publications like DataRoma, they do not disclose the short positions these managers do take in order to quote-unquote hedge their portfolio. So for starters, hedging just means that it's a short-term insurance to protect the portfolio against the upcoming volatility. So for most funds, they tend to employ a long-short strategy, but the 13F only paint half of the picture. And for masters like Ray Dalio, who has a masterclass on hedging, will be employing such strategies as and when he likes. So in another universe as well, George Soros, who has been a staunch critic of China, its government, its system, its capital markets, have recently started a position in NIO. Yes, NIO, the company that was crowned as the Tesla of China some time back when it was skyrocketing like 3,000% or something like that, but has since crashed more than 70% from its peak. I still vividly remember someone sending me a Wall Street Journal article that featured George Soros' opinion on China with the headline, "Xi's dictatorship threatens the Chinese state." So scary, I'm so afraid. And it was essentially just an article to throw Xi and China into the dumpster. Firstly, for those of you who don't know who George Soros is and what's his background, please at least do some quick research on his background. He's not a simple man, and not just your normal hedge fund manager. Secondly, like I always say, profits and opportunities knows no master. Nobody cares whether you're from US, China, or even Africa. As long as there is potential alphas and profits to be reaped, investors will be queuing up. So they don't report to a particular country or a person, especially so in capitalism. So much for hating on the government and not trusting the structure. And soon after, in less than a year, you proceed to buy Chinese equities. Cool story, bro. Start reading between the lines, my friend. With that, I'll see you in the next video, but more importantly, I'll see you on the moon. Goodbye!